The UK housing market's been an incredible investment over the last 20 years. It's far outstripped inflation, but that's been for some very specific reasons. Firstly, interest rates have been falling for the last 20 years, so that's helped people get credit so they can get onto the housing ladder. But also there's been a big demand-supply imbalance. There's been very little supply and very big demand due to demographics, but also due to immigration. So we think that is about to change. We think the balance is about to shift. So let's drill into the reasons why we think the UK housing market is not such a great investment now. Let's use this image of a seesaw to imagine what drives UK house prices. Low interest rates are very important because if you can borrow cheaply, you can borrow more, and that pushes up house prices. That only works up to a limit. If the amount of borrowing is more than a multiple of your disposable income, banks will no longer lend, and that cap is around 4.5 to 5 times your disposable income. As with any market, demand and supply are very important, and the UK housing market's been characterised by having very strong demand and very little supply. That demand-supply imbalance has pushed up UK house prices, even though affordability is very poor in the UK. And the final pair of factors we'll consider on the seesaw are wage growth and inflation. If wages are growing at 2%, but the cost of living is growing at 3%, then disposable incomes will fall and houses will become less affordable, and that tends to drive down house prices over the long term. Now let's drill into some of those factors in detail to see how that's going to affect house prices in the short and medium term in the UK. Let's start with the Nationwide House Price Index, and we'll look at the comments by Robert Gardner, Nationwide's chief economist. As he looks into his economic crystal ball, he thinks the housing market outlook remains clouded, which is a sideways allusion to the uncertainty around Brexit. As a typical economist, he gives you both sides, on the one hand, on the other. The economy didn't slow after that fateful summer referendum, and unemployment is at a very low rate, the lowest it's been for 11 years. And when unemployment is low, that tends to push up real wages. However, the one place where Brexit had a very large effect was on sterling. At the moment we're starting to see fuel prices increase, but the Bank of England expects the general cost of living will increase as well. This fan chart is their projection for what will happen to inflation over the next 3 or 4 years. Most likely it'll go well beyond their 2% target, maybe up to 3% or even 4%. But as Robert Gardner says, that's going to have an effect on real wages. That's when you take away inflation from your wage growth. When your disposable income falls, then you spend less. And because services are such a big part of our growth in the UK, that'll be a considerable drag on economic growth. And it could also affect employment. The Nationwide thinks this squeeze on household budgets will intensify. The graph on the right shows UK growth for the last 60 years, alongside UK house price growth. When there's a recession, in other words negative growth, the housing market tends to fall in value. But even if there's a slowdown in growth, that tends to slow down the housing market, hence their concern. But before we get too pessimistic, they point out that this will just be a slowdown. They only expect house price growth of around 2%. But if inflation is 3%, that means in real terms house prices will fall. And they think the lack of supply is what will shore up UK property prices. The Halifax survey is in broad agreement with the Nationwide. They say that currently we have fairly robust house price growth, but it's decelerating, which means it's growing more slowly. Again, they talk about weaker economic growth and increasing pressure on spending power, but they also mention affordability being a problem. So that's where we are now. Now what's really important is what's going to happen to interest rates. Now let's step back a moment and look at interest rates over the long term. The blue line at the top is US interest rates, the Bank of England's in the middle in green, and European rates are at the bottom in red. You can see that over the last 7 years rates have been flatlining both in the US and in the UK. Only recently has the Federal Reserve started to raise interest rates as they come out of the long recession following the global financial crisis. The question is, are we going to follow suit? Most people think not, but we think we might. Currently rates in the UK are the lowest they've been since 1694. That's when the Bank of England was founded by these gentlemen wearing wigs. But the US central bank, the Federal Reserve, has dropped some very strong hints that after they started raising rates in December, they're going to continue doing that. And as Janet Yellen says here, if they wait too long to raise rates, they may have to raise them more quickly. and that could disrupt financial markets and push the US economy into recession, and that would be bad for everybody. In another video, we've laid out in detail why we think US rates and UK rates are strongly linked. This is through trade, financial markets, and something called animal spirits. But the gist of the argument is that if the US does manage to engineer 4% growth, that will spill over into other countries. Better growth in the US will mean rising interest rates, and rising interest rates in the US will drag up interest rates in the UK as well, which means that that 20-year downward trend in rates will be at an end. And going back to the seesaw, that'll be a drag on the UK property market. How about the race between inflation, which is like King Kong, versus wages, which is like Godzilla? Who will win? Well, here's the latest data on inflation in the UK. After a period of very low inflation, we're finally starting to see it spike, largely because of the Brexit devaluation of sterling. Wages, on the other hand, didn't spike as a result of Brexit. That means that if we look at real earnings growth, which is the rise in your weekly earnings minus the rate of inflation, that's been steadily falling, and it's set to fall more quickly. And that's what's got the Nationwide and Halifax economists worried. It's this fall in the buying power of your wages. How about the balance between housing demand versus housing supply? A very strong support of UK house prices was that supply has been very limited. If we look at who actually built the houses after the Second World War, in pink you can see that local authorities were very important up until around the 1980s. But that component of supply was never really replaced by private enterprise, and as a result housing supply has been constrained ever since. The structure of the UK house building market is also unhelpful. It's dominated by 8 very large building companies, and those 8 companies account for more than half of the new homes which are built. As the UK ages, many empty nesters want to move into smaller homes, or older couples want to downsize into bungalows. But new housing supply is just not producing that kind of dwelling. And local authorities, which used to provide so much of the supply, are prevented from doing so by controls on public borrowing. On the other hand, demand has been extremely strong. That's because UK life expectancy has increased, and people are tending to stay in their homes, partially because they can't move into appropriate new build. Rising population due to immigration has also tended to increase demand for homes, as have rising incomes and mortgage availability. Plus there's a trend towards living in one-person households. Now what you don't want is the average age of a first-time buyer to continue to rise, because that's unsustainable. And in order for that to happen, you have to build at least 300,000 homes a year. And that has to be for the foreseeable future. If you look at the net additions to the housing stock that were actually created, you can see that we're well below that target. Fortunately, in February, the government came up with a solution. They produced a white paper called Fixing Our Broken Housing Market. However, the reception wasn't all positive. John Bell, an analyst at Barclays, said that you could have mistaken the contents being distributed by the Ministry of Homeopathy because they were so watered down, and he failed to find anything of substance in its 105 pages. Here's Theresa May's summary taken from the foreword to the white paper. She outlines the need for more land for house building, and that each region will have to have up-to-date plans in place so that we're comfortable with how those houses look. Secondly, she wants to streamline the process so that once planning permission is given, the homes are built quickly. Thirdly, she says the government wants to break up the oligopoly. In other words, the dominance of the house building market by those 8 companies that we saw. And also housing associations and local authorities will come back to the party. And for those who can't afford to buy a house, the government's going to help people who rent. Finally, let's look at affordability. To see how affordable UK houses are, we can take the household debt and divide it by the income of the household. You can see that the UK is highly indebted, even after the fall in debt after the global financial crisis. We're still up to our eyeballs in debt, and a large part of that debt is due to mortgages. If we compare house prices with disposable incomes, we see a very similar picture. We're close to levels that we saw just before the financial crisis, which means that affordability is being stretched to the limit. As you'd expect, if we break it down geographically, it's mostly London and the South East which has the lowest affordability. in order to buy those houses, the loan to value, which is the proportion of the total house price that you borrow with your mortgage, peaked just before the global financial crisis, but now it's started rising very sharply again. It really does look as if we're pushing affordability to the very limits. So going back to our seesaw, we're expecting low interest rates to go away. Housing demand will probably remain strong for some time, but wage growth will lose the battle against inflation. The government at least has a plan for increasing housing supply, and as always, affordability is stretched to the very limits. So that's why we think the overall balance of factors is shifting towards moving house prices lower, which is why we think the UK housing market is becoming much less attractive. Remember, this is not a recommendation. If you want financial advice tailored to your individual circumstances, seek independent financial advice. Do you think UK property is a good investment? We'd love to know. Tweet us at PensionCraft, message us on Facebook, and if you like these videos, subscribe to our channel.